Morning, Damaris.
Good morning, Melody. How are you?
Fine, thanks. Yourself?
I'm okay, thank you. Good morning, everyone. We'll be beginning shortly, so let's give other attendees another minute to join us. Good morning, everyone. My name is Damaris Mukulu, the head of marketing, brand, and communication at Genghis Capital. Welcome to the Genghis Weekly Investor Briefing. We're glad that you could join us on yet another Monday. This morning, our research analysts are going to walk us through the macroeconomic markets. They're also going to talk to us about the fixed income and equities segment. As usual, our webinars are interactive. We urge you to use specifically the Q&A tab to send in any questions you may have for Churchill, Melody, and Wesley. After their presentations, we'll be able to tackle every single one of your questions. So if you have any concern or a query regarding a counter or a bond or a specific development in the market, feel free to use this opportunity to get answers to your particular questions. I think that's it. You could also use your chat for any concerns or queries you have. So over to Churchill, Melody, and Wesley to kick us off this Monday. Thank you.
Thank you. Good morning. Thanks, Damaris, for that wonderful introduction. So we'll kick off as usual with the macroeconomics and fixed income, and then my colleagues will touch on the equity segment. So I'll start with the macroeconomics, just a review of what came out last week in terms of July diaspora remittance. So this was contained in the CBK weekly bulletin as at the end of last week. Specifically for the month of July, we saw an increase of, July, it was reported that the remittance for that specific month was $337 million. That's around 36 billion shillings. And that was a 21.6% year-on-year increase compared to a comparable month last year. This first 7 months of this year, we've seen accumulative $2.1 billion in terms of diaspora remittance, and that's a 20% increase comparable period last year. And the 12th month, basically between August last year all the way to July this year, the cumulative diaspora remittance is around $3.4 billion. That's around 370 billion shillings, and that already is a 20% increase from comparable period the previous time. So diaspora remittance keeps on hitting new highs, and it's a boost on the current account deficit, primarily because it tries to deflate the mechanized trade deficit. We'll see a bit about it in the next slide. So, and right now the government strategy is a move away from unilateral remittances. For instance, say Wesley's uncle sends Wesley every month $10,000. That's 1 million shillings equivalent. So that's primarily has been how the diaspora remittance has been done. The remittance being sent. But now what the government wants, at least to tap these diaspora remittances towards supporting some sectors or diaspora bonds, something like that, to at least formalize this diaspora remittance. So that was contained in the post-COVID economic recovery strategy, but you haven't seen a coherent measure, at least in terms of a time frame, at least in terms of how to fully implement that strategy. So it's just a wait and see how that particular proposal will be implemented. But that said, we're looking at one of the banks, Equity Group, taking the lion's share of diaspora remittances. The first 6 months of this year, we saw an overall 190 billion was disbursed, was sent as diaspora remittance. But last week's presentation, we had Equity telling us that it managed to process 176.2 billion shillings. So that is already 88% of what diaspora remittance that came in the first 6 months of the year. So it's just telling us that they have managed to harness the strategic partnerships that it has had with international payment players, so as to be able to see this outsized processing of diaspora remittances. Moving on to the next slide, basically the data that was put out in the leading economic indicators. So it's been a while since we saw an update in the leading economic indicators, but last week, for some reason, Kenya National Bureau of Statistics updated the leading economic indicators up until the month of June. So based on that, we picked some statistics around the trade data, mechanized trade, basically the goods that either we export or we import. The statistic for the first half of the year, exports up to 369 billion. So that was 16.3% year on year compared to the first half of last year. Imports also now outpacing the growth in exports by nearly 28% to 992 billion. So that's the statistics that we saw. But then again, looking at the cumulative up until June, the 12th month up until June. So primarily we're looking at July 2020 all the way to June 2020. We saw that the exports was 93 billion, and then the imports was 1.9 trillion shillings. So that gives us a trade deficit of 1.2 trillion shillings. But that said, this leading economic indicators doesn't have services receipts. Services are now things to do with tourism or even conferencing that Kenya offers as an opportunity. So that figure is not contained in the leading economic indicators, but that is what should be contained in the balance of payment data once it's out. So that's something that we'll keep an eye on. That said, CBK reported that current account deficit as at the end of June was at 5.4%. So looking at the trade deficit at 1.1 trillion, we don't know what the service data is. We know diaspora remittance for the first 6 months was 190 billion. So 190 billion reduces the trade deficit. So from 1.2 trillion shillings, and then you net off 190 billion. So it's roughly 980 billion deficit, but we don't know what the service trade service receipts was. But working backwards, 5.4% of GDP of 11.2 trillion is giving us roughly in aggregate terms that the current account deficit is 603 billion. So this particular deficit has to be funded either financial account or a capital account, but primarily by the financial account. That's where we talk about even the monies that come in, be it from the IMF, be it from the World Bank, it's a way of financing this deficit. So that's just my quick comment. In terms of our calendar this week, it's a bit light, but globally, we're expecting we'll be monitoring the Jackson Hole Symposium. It's an annual conference, research conference that brings a number of the central bankers to Jackson Hole, basically just to deliberate of issues. But the hallmark of this research symposium will be the speech by the governor of the U.S. Federal Reserve, that's Jay Powell, just to give us some snippets when some of the either are tapering. By tapering, what happens is currently the Fed buys 80 billion in terms of asset purchases. It buys bonds and other assets to the tune of $80 billion. So a taper basically is a reduction from say 80 billion to 60 billion or 40 billion. So that speech by him will either give indication of a tapering, or it could give when is the most likely time, when is the next time that the Fed will now increase their rates from the record levels that we are. So that's something that most of the market participants will be keeping an eye on during this week. Moving on to the fixed income, last week we saw a steady in terms of activity. It was a decline in the order of negative 0.2% week on week basis. Most of the trades that were executed were on the 20 years, mainly on the run. By on the run is we talk about the 20-year paper that was issued recently, and that's the FXD1 2021-20 that was issued in the primary for this month, primary auction this month. We saw the results the other week. It started trading last week, and then it had the lion's share of the trades. I think around 23 or 24% of the trades that were executed last week were on this particular paper. Ideally, the recent papers are the ones which are quite liquid, so it goes without saying that activity was primarily on this particular issue. Weekly T-bills, these numbers, I hadn't updated them, but for last week, we saw the aggregate amount of bids placed was around 28 billion, which was a performance rate of 118%. So what you're seeing on your slide are the data for the previous week. Basically, it was depressed because of the coinciding primary bond auction that was there in that week. But last week we saw a rebound in terms of interest in the T-bill segment. Slight uptick in the 91-day tenor in terms of the yields, but 182 and 364-day remained flat. Subscription for 364-day, we haven't seen that low subscription for the 364-day, and it was below the psychological 1 billion in terms of the interest for that particular paper. And it takes us all the way back to December 2016. Okay, so what happened in December 2016? This is the time which we've never seen something like this, whereby on the weekly T-bills auctions, CBK, without giving any reason, canceled the results for the 364-day T-bills. So just going all the way to that particular event, we haven't seen subscriptions below 1 billion for the 364-day T-bill. Interest was now on the, mainly was on the 182-day T-bill and also the 91-day T-bill last week. We don't know whether it was a one-off or it will something that will continue in the next coming session. It's anyone's guess. So in terms of liquidity, interbank rate went up by 0.33% to an average of 3.08%. CBK was active in mopping up excess liquidity. We'll be talking about the excess liquidity. By excess liquidity, we mean that banks have, they're liquid over and above what the CBK would like them to be. So that's our interpretation of liquidity. Liquidity might mean different things, but now for this, in the reference that liquidity meaning that the banks have more monies as to what CBK will want them to have. And CBK now mops up the excess liquidity through term auction deposits. So for last week, they, on I think 4 different occasions, they had to mop up excess liquidity. The bids that they received was 60 billion and 60.25 billion. They accepted 55.25 billion at a weighted average rate of 5.387%. Net domestic borrowing right now, as per our calculation, government securities, this is now the T-bills and T-bonds, is close to 174 billion, and that's roughly 26% of the target in the current financial year. So moving on ahead, last week CBK announced this month's primary bond issue. Well, it was a curveball in the sense that we just closed out the primary bond issue for this month the other week, and then it didn't take a while, and then here we are Friday evening, the announcement of next month's primary bond issue, and it's an infrastructure bond, a 21-year infrastructure bond. But then the weighted average life for this particular for this infrastructure bond is 15.5 years, in the sense that after year 10, that is 2031, there'll be partial redemption of this particular bond, 50%, and then the remaining 11 years will now continue like that. So for instance, if you invest $1 million in this particular paper, at year 10, 2031, you receive 500,000. So the remaining 500,000, if you hold this infrastructure bond to maturity, will now continue, but you receive your 500,000. Of course, in addition to the semi-annual coupons that you'll be receiving up until then. So that now takes the weighted average life to 15.5 years. The target is the target is 75 billion, and then the proceeds of the bond is towards infrastructure projects in the current financial year. Let me take you back to the Finance Act 2021. And one of the things that stood out in relation to infrastructure bonds is that they specified which projects will benefit from the infrastructure bonds. I think it was things to do with hospitals. No, I think things to do with roads, energy, water. Yeah, so it was explicitly stated in the Finance Act 2021 what an infrastructure bond is. All along, as per the income tax, infrastructure bond is seen as a tax-exempt instrument, but exactly what is an infrastructure bond? So that was actually stated in that Finance Act 2021. I thought that with that explicit statement, we'll see that even in the prospectus, or there'll be like a drill down into the specific projects that will benefit from this infrastructure bonds, but clearly I was disappointed. But nonetheless, Finance Act 2021 specifies the sectors that will benefit from this particular proceeds of the infrastructure bond. It doesn't have a non-withholding tax infrastructure bond, and as compared to the FXD, fixed rate bonds in the NSE. So that is the appeal. It's appeal, and that's where it grows interest even from foreigners. So in as much as 75 billion, because of the liquidity, we expect that there'll be massive subscription for this particular paper. So how do we go about placing our bids for this particular paper? Looking at the previous IFBs, this is the third IFB that has come out this year. The first one, 16-year infrastructure bond, it had a coupon rate of 12.257%. The 18-year that came in April, it had a coupon rate of 12.667%. But nonetheless, looking at even the 18-year paper, in as much as its yield was 12.667%, it has come down. I think last week it closed close to 12%. So a reduction of 0.6% on its yield from the auction that was there. That's on the 18-year paper. So looking at if an investor would like to invest into the paper, one easier way is to place an uncompetitive bid. So an uncompetitive bid is if you have an amount less than 20 million, you don't indicate your yield that you will prefer. So you just put in your amount and then you tick against, you place in an uncompetitive bid. So that you are sure that whatever amount you place, so long as it's below 20 million shillings, it will be successful. But if you'd want to place a bid, I mean, they're different. We'll be giving our views next week once we've been able to get enough market color. But that said, as indicatively, 18-year infrastructure bond that was issued right now is around 12%. So from that is where we can now start forming our opinion around it. But that said, looking at, say, a comparable, if you go to the yield curve doesn't give the yields for the infrastructure bond, it gives the yields for non-infrastructure bonds. Currently, 18-year, as an example, is around 13.19%. So 13.19% for an 18-year paper, which is not an infrastructure bond. But yet we have an infrastructure bond, which is 12%. Obviously, the difference is because a non-infrastructure bond attracts withholding tax of 10%. So going back to the yield curve, and specifically for the 18-year, whereby it's at 13.19%, assuming that there's an equivalent paper that doesn't have a 10% withholding tax, what will be the equivalent rate? So basically 13.19%, an equivalent paper. So it's discounting it by 10%, that 13.19%. So the math is coming to around 11.87% for an equivalent paper that doesn't attract withholding tax. But now the yield for the comparable IFB is 11.98%, 12%. So those are some of the math that you can be able to work. But of course, in alliance with our dealing team. So that takes us to the trade of the week, looking at, because there'll be interest in IFBs the next 2.5 weeks up until the sale period closes. We'll likely see a repricing of the current IFBs that are trading, and mainly we're looking at the IFB 2021-18. Sorry, this is actually this thing is supposed to be by IFB 1 2021-18, not 2021-2021. Sorry about that. It's IFB 2021-2018. Yeah, so the rationale is because there's a new IFB paper, and what I mentioned earlier, the newer papers trade more frequently, so interest will not be on the older papers, and because of that, they're likely to reprice higher. So that's our justification of buy for IFB 1 2021-18 between 12.1 to 12.15%. So that's what we are seeing, and that's our trade for the week. Let me end there, handing over to Wes.
Good morning to you. Let's have a look at activity in the bourse during the past week. The market was vibrant in the week as signaled by the uptick in the benchmark indices. The Nairobi All Share Index and the NSE 20 peaked 2.8% week on week to close at 186.88 and 2015.77 respectively. That said, activity in the bourse rose as seen in the 86% week on week rise in turnover to 4.56 billion. On the top gainers, we had IGAD, Unga Group, NSC, Olympia, and Stanbic, CIC Insurance, Kakuzi, Scan Group, and Kabasid, also Transcentury, dwindled during the week to earn a spot in the week's top losers. Also, we saw NBV shedding some points during the week on its closure of 5 shillings and 22 cents. Some salient news the week was Safaricom touching a new 52-week high of 45.25 shillings, and that was on Tuesday, and its closure also set its all-time high at 44 shillings and 9 cents. The likely driver to the impressive rally has an aspect of foreign buyers tied to its hip, as foreign investors have a huge stake in trading in the frontiers counters. In the past week, for instance, they had an inflow position of about 1.6 billion on Safaricom. That might have an aspect of rebalancing of their portfolios to changes of some indices like the MSCI, the Morgan Stanley Capital International Index. On foreign participation, a glance of the activities of foreigners, we see that foreign investors accounted for 51.6% of the week's turnover. They had an overall net inflow position of 840 million. The 2.4 billion captured on the slide was their turnover for the week. They accumulated on Safaricom, Equity, and KCB while exiting on EABL and StanChart. On Tuesday last week, Kakuzi released their half-year results. They reported a 28.7% year-on-year decline in their earnings per share from 13.92 shillings to 9 shillings and 93 cents. The counter's sales declined marginally, coming in at 888 million. The profit before fair value gain in non-current biological assets and income tax grew 37.7% year-on-year to 256 million, and the fair value gain in non-current biological assets grew by about 13.7% year-on-year to settle at 20.6 million. Their profit after tax declined 28.6% year-on-year to 194.6 million after an 82 million income tax adjustment on the gross profit, which was reported at 276. Their balance sheet grew by 6.4% to settle at 6.9 billion, and the board did not recommend an interim dividend. On Wednesday, we had their Total Energy Marketing Kenya first half results. They reported their earnings per share at 2 shillings and 70 cents, which was a 50% year-on-year rise. The counter had a solid growth in their top line, reporting gross sales at 51.8 billion, 16.6% year-on-year rise. The cost of sales and indirect taxes and duties grew by 8.6% year-on-year and 33.7% year-on-year respectively to settle at 29.8 billion and 17.3 billion respectively. Their gross profit for the 6-month period ended 30th June 2021 grew 16.8% year-on-year to 4.7 billion, emanating from the increased sales and sustainable unit margins. Also notably, the operating expenses declined marginally by 30 basis points to settle at 3.1 billion. Net foreign exchange loss declined 96.5%, which was really impressive. It settled at 2.8 million, and this was attributed to the sustainability of the shilling against the dollar in the period under review. Other income from diversified activities in the counters, retail outlets closed at 951.5 million, which was a 30% year-on-year growth. Their profit after tax stood at 1.7 billion after 781.6 million income tax adjustment on gross sales. They closed the period at a cash-rich position of about 9.9 billion. That's a 66.7% year-on-year growth, and the board did not recommend an interim dividend. On Thursday last week, Sanlam Kenya released their results. They reported their earnings per share for the 6-month period ended 30th June 2021 at a loss of 2 shillings and 9 cents from a loss of 83 cents in a similar period last year. The counter registered an impressive growth in their top line, with gross written premium coming in at 5.9 billion. That's about 38.5% year-on-year growth. Investments and other income grew by 23.4% year-on-year to settle at 1.5 billion, while net earned premiums were reported at 4.4 billion, realizing about a round figure of 46% year-on-year growth. Total income for the period under review grew by 39.3% year-on-year, settling at 5.9 billion. Notably, the total expenses grew faster than their income, realizing to the loss that was reported in the period. The total expenses came in at 6.2 billion. This was attributed to in part by 64.9% year-on-year growth in net claims and policyholder benefits, which are reported at 4.1 billion. The total comprehensive loss for the period under review was reported at 291 million. That's an over 190% year-on-year decline. And also, they registered a 5.8% year-on-year growth in their balance sheet and closed the period at a cash position of 2.6 billion. Looking at what was given this morning, we had Umeme release their interim results, and combing through their results, the following pointers stood out. The revenue grew by about 9%. Gross profits rose by a round figure of 28%. Operating costs grew by 12%. Financing costs declined by 15.4%. Their earnings before interest, tax, depreciation, and amortization grew by 48%. And importantly, the board did not recommend an interim dividend. And looking at the sub-Saharan market performance, the Nairobi All Share Index outperformed its peers on a week-on-week median of 20 basis points. The market's price to earnings ratio was above the African median multiple of 11.6, while its dividend yield was below the median by about 2%. Looking at the corporate calendar, we have Stanbix holding 1 shilling and 70 cents interim dividend that will be on 6th September. To you, Melody.
Thank you. So, looking at the financial sector, so we'll just start by looking at the share prices. Just give me 1 second. So, as we've seen with the earnings season now, where we're deep in it, the activity has been a buzz in the bourse with the banking sector stocks. We've seen Stanbic, the share price closed at 94 shillings per share, which is a 9.3% rise week on week. And this could be due to investors reacting to the interim dividend announcements and as well as the impressive first half results. Stanchart, Equity, DTB, and I&M counters were also up in the week to close at 134.75. That's Stanchart at 2.9% increase week on week. Equity at 52.5, which was a 3% increase week on week. DTB 65 shillings, 1.2% rise week on week, and I&M at 23 shillings with a marginal rise of 0.22% week on week. So KCB, however, fell marginally by 0.31% to 47.95, and this might be due to the high non-performing loan figure, which is the highest on record at 95.7 billion. Looking at insurance, Sanlam, Jubilee, and Britam closed higher than at the beginning of the week. Sanlam at 11.9, which is a 3.5% increase week on week. Jubilee 360 shillings, which is a 2.3% rise week on week, and Britam at 8.28, a 0.7 rise week on week. Though investors had bearish sentiments on CIC, Kenya Re, and Liberty, with CIC closing at 2.78, which was a large decline of 12% week on week. Kenya Re 2.47, which is a marginal 1.6% decrease, and Kenya and Liberty at 9 shillings, which was a 2.6% decrease. So as my colleague Wesley had said earlier, Sanlam, so its losses were mainly due to high, swollen claims and payouts to policyholders, though the management has confirmed that it's restructured $27 million of its loans to a 3 billion shilling policy, which is supposed to mitigate future risks from exchange losses from the Kenya shilling against the dollar, the US dollar. So that could be one of the reasons why the price went up. So looking at the financial highlights, the CBK released its quarterly credit officer survey for the quarter ended June. So from this report, gross loans increased by 2.3% to 3.1 trillion, which is a higher growth rate than the previous quarter, which was 1.4% increase quarter on quarter. So this growth was mainly due to increased loans to trade and real estate sectors. Looking at the NPL ratio, that's the non-performing loans ratio, it improved from 14.6% in March to 14% in June 2021, mostly due to a decrease in NPL loans, which is 1.7%, and a 2.3% increase in gross loans. So looking at quarterly profit, it increased by 4.6 billion from 45.89 to 50.3 billion in June, mostly due to higher income as compared to increase in expenses. So liquidity for the sector as well has been high, reaching 56.3% from 56.3 to 56.8 in June rather. And from the survey, 43% of the lenders indicated that they would direct their money to treasury bills and bonds, which will further squeeze out the private sector, which the the private sector lending was quite marginal from the 9% it was in around January. So 23% of the lenders also say they're going to invest in bonds, 20% in T-bills, and 19% said they'd lend amongst themselves. So you can see there's still some aversion to lending. So looking at sentiments for the non-performing loans in this coming quarter to September, so it was rather divided. 38% said that NPLs are likely to fall, mostly due to recovery efforts, while another equal 38% expected it to rise due to the continuing pandemic. So we're just going to wait and see how the quarter plays out. So some of the factors affecting credit are political risk, issuance of equity, issuance of debt securities, and the retention of the CBR rate, which is the central bank rate, which is currently at 7%. So moving on to the financial results, so that equity reported a 97.7% growth in earnings per share to 4.8. This performance was mainly due to the decrease in loan loss provisions, which fell about 63.7% year on year to 2.9 billion. And its gross NPLs actually fell 23.3% quarter on quarter to 45.6 billion, which is quite an improvement. So looking at the loan book, it grew to 504.8 billion, which is a 28.9% year-on-year increase. And the deposits as well rose 50.7% to 819.7. And this can be attributed mostly due to the consolidation and integration of BCDC Bank Congo. Net interest income went up 26.5% to 31.2 billion. Mostly due to interest from income from loans and also from government securities, which rose 29.8% and 30.2% year on year respectively. Although interest expense on customer deposits weighed down on this net interest income, which rose almost 51.1% to 9.3 billion. Non-interest income went up 44.2% to 20.8 due to FX trading income, which grew impressively by 82.8% year on year, mainly due to the group's diversified business interests. As we've seen, they're quite active in remittances, in diaspora remittances. Fees and commissions on loans went up 41.6%, and other commissions rose 42.8% to 9.7 billion. Looking at their expenses, they went up marginally by 3.8% to 28.1 billion, mainly due to the reduced loan loss provisions, which they've covered with credit risk guarantees, and the management didn't recommend a dividend. So moving on to the Cooperative Bank, they announced a marginal rise in earnings per share, 2.3% year on year to 1.26. Their gross non-performing loans stood at 50.9 billion, which was a marginal decrease of 2.1% quarter on quarter from the first quarter ended March. The loan book expanded 10.7% to 301.2 billion, and the deposits rose 6% to 407.7 billion. Net interest income grew by 18.3% to 18.8 billion, which was mostly driven by increase in interest income from loans and advances. So this performance might be due to the loan book growth as well as the resumption of suspended interest payments. So this net interest income was also supported by 42.3% year-on-year rise in income from government securities, as we've seen banks putting their money in government papers more than lending to the private sector. For non-funded income, it went up 24.3% year-on-year, 10.3 billion, mostly due to the fees and commissions in loans, which went up significantly to 22.7 billion. Total interest revenue went up 24.3% to 10 billion, with it, however, being subdued by a drop in other fees and commissions to 5.3 billion. So looking at the expenses, it grew 14.4% year on year, mostly due to the uptick in loan loss provisions, which was contrary to what other banks are doing. For them, it went up 123% year on year to 4.2 billion. And also other operating expenses increased 31.4% to 5.8, which was mainly also due to the currency, because of the South Sudan currency hyperinflation. So profit before tax was supported by the top line to grow 9.6% to 10.5 billion. And there was no mention of an interim dividend payment. We've also seen that COP has now extended its joint venture with the South Sudan government to renew the co-ownership of its subsidiary for another 3 years. Let's move on to KCB. For KCB, the earnings per share grew 101.9% year on year, which is quite a strong increase to 4.7 from 2.36. Their NPLs, however, that's the gross non-performing loans, to that 95.7 billion, the highest of the listed banks, which is a 2.3% decrease quarter and quarter. So there is some improvement, but there's some work to be done. So the balance sheet actually crossed the 1 trillion mark, growing 7.2% to 1.022 trillion, with 8.4% year-on-year rise in loans, with the borrowing hitting 35 billion, which was 63.9% increase. We've seen that in the news that been receiving funding from these multilateral development banks. So that could be a pointer to the increase in borrowing. Net interest income, driven by increased lending to manufacturing and personal household sectors, went up 17.2% to 36.4. For non-funded income, the growth was slower at 5.9%, which was mainly due to lower fees and commissions. As we've seen, there's still the waiver in place, which was instructed by the CBK. So for transfer between money, different mobile banking wallets, the waiver is still in place. So that could be a pointer to why the non-funded income went down. For expenditure, it fell 9% year on year because of the loan loss provisions that they reduced by 40% to 6.6 billion. The NBK, National Bank of Kenya, which they had acquired, it continued its positive earnings, earning around 717.6 million, up from a loss of 381.3 million at the same time period last year. So as we move to the trade idea of the week, so it's a hold on KCB Group. So the management had announced that the acquisition plans in Rwanda and Tanzania are almost complete, and they should, with the expectation that the one for Rwanda, that's Bank Populaire de Rwanda, the integration should be happening in this coming quarter. So according to the circular to shareholders, it's estimated about 64 billion will be added to the balance sheet. So the management is also looking into going into DRC Congo and Ethiopia, where they already have a representative office. They're also looking at monetizing their mobile transactions to earn around 40% income in unfunded income in about 2 to 3 years. So these are a few of the reasons, as well as the plan to roll out a backend system to ensure that all its subsidiaries run under one platform, which is going to give cost efficiencies and also add to synergies. So just though it's not on the slides, we have received the results for Standard Chartered Bank. So there was a 33.2% increase in profit before tax to 6.8 billion. with loans growing, loans actually contracting 3.3% year on year to 130.3 billion. Deposits, on the other hand, went up 8.5% year on year to 278 billion. Looking at net interest income, it actually went down 7.5% year on year to 11.8 billion. This could be attributed mostly to now the shrinking in the loan book. They're having a more prudent credit management policy, you could say. For non-funded income, it's gone up 13.5% year on year to 4.9 billion. As we've seen, they have made strides in the digitization of their products with the full FX capability and insurance all online. And they also have they have digitized the retail bank. Looking at operating expenses, the total operating expenses went down by 15.8% year on year to 7.3 billion. And this was mostly, as I said, banks now are reducing their loan loss provisions because they feel they've adequately covered their NPLs. So it's actually gone down 60.7% to 638 million. However, the non-performing loans went up to 22.86 billion, which is a 9.4% increase year on year. So that's it from my end. Back to you, Churchill.
Thank you, Melody, for that presentation, as well as the other research panelists who I know will be coming back online with us. So today we've gotten quite a multitude of questions, so we'll just dig in straight away. The first question was from Justin. Justin is interested in the diaspora remittance numbers. He asks, can you clarify on them? The 88% for equity, are those funds being sent to equity accounts, or is it equity processing payments for companies like Sendwave, etc.? What are the numbers for other banks? I also saw in the chat a question related to this diaspora remittance. Let me look for it. Yes, here from, I believe it's Moses Okundi. What data do you have from other financial institutions on diaspora remittance? Would like to compare it with equities. So Churchill, I believe this is for you.
Thanks, Damaris, and also for those set of questions around diaspora remittance. And it's something, I think this is the first time that you're talking about diaspora remittance and then trying to compare it with one of the listed names. And it's because we're just trying to map if diaspora remittance has been, because they report in dollars, and then we did the quick conversion to Kenya shillings using the equivalent exchange rate at that time. So for the first 6 months, it came to 190 billion. And yet Equity reported that the diaspora remittance in transaction volume, one of the presentations that they had last week in its 1H results was that it had gone, they managed to process 176.2 billion. And explicitly, they said that it's because of the strategic partnerships with a number of the international payment providers, think PayPal, Wave, and I think 4 more other people. And if we go back into how these payments are being processed, remember that you'd have to go physically to say one of the money services remittance providers. I think right now there are 18. So there are some select brick and mortar branches that they do have. But because either banks have the last mile distribution, because rather than walking into the money service, the money remittance provider, at least they have been able to connect with Safaricom and other banks such that it's much easier to connect through the banks. But based on these numbers that we are seeing, if they managed to process 176 billion and they say this diaspora remittance, the service 190 billion, that's where the 88% was coming about. Against other numbers you haven't, against other banks you haven't seen, and know that even we'll be having later on this afternoon, evening with KCB. Perhaps they'll give us their snippets around diaspora remittances. Coop Bank analyst call was sometime last week. So we might be able to get other data. And another thing that we also perhaps we might be blindsided is, are we confusing diaspora banking with diaspora remittances? Because those are two different things. Diaspora banking is perhaps banks trying to get accounts from Kenyans in the diaspora, which is separate from diaspora remittances, that unilateral transfer of monies from, say, your relatives who are abroad sending you money for use locally, as opposed to banking, which has its own diaspora products. So that's one other thing that we're yet to properly map out so that we can be able to stick to that theory. But ours, the 88% was, if indeed the 176 billion that Equity reported was indeed diaspora remittances, which we are believing it is, because from some of the conversations we've had with the money remittance providers, they say that Equity is quite big in this space. So it might be having that lion's share at 88% compared to the monies that was sent from abroad locally. So that's where our hypothesis is coming about.
Okay, thanks, Churchill. I believe the engagements you spoke about that are happening later, even today, addresses Moses Okundi follow-up question. So I'll move on to the next question from Anthony Sure. He says, you mentioned monitoring the Jackson Hole Symposium. Do changes in the US monetary policy have an impact on the CBK's policy stance? Or how exactly do they impact the Kenyan economy as a whole?
Well, it's not, it won't have direct impacts as per se, but implicit impacts. For instance, we say right now we're living in the Fed's world. Whatever the Fed is doing has some ripple impact even locally, but it may not have what the Fed is doing in terms of its monetary policy action may not be replicated locally, like for like. For instance, I think the last FOMC meeting, Federal Open Market Committee meetings, there's that indicator that the rates, this is now the rates in the US. Right now they're rock bottom level between 0% to 0.25%, that the earliest that it will be increased to be around 2023 or 2022, 2023 thereabouts, but it keeps on moving. So, but based on the symposium that is happening this week, what the market observers in the US are seeing, at least it will be able to give some more or less like sequencing to that rate hike, whether it will be 2022 or 2023. Is it a reduction in what the Fed purchases on a monthly basis, and based on that, what will be the next sequence of that will be the rate hike. So what people are saying is, when is the likelihood of a fast rate cut after being at these depressed levels? But it won't have a like-on-like impact on what the CBK does, because CBK's mandate is just to look at whether its mandate is on price stability. So if inflation flares off the roof, say to 20%, and it's something, it's because of demand pressures in the economy. So that means that our economy is performing way above its potential. So to cool the economy, it has to either to increase the rates, at least to stabilize that runaway inflation, which may not necessarily be impacted by what's happening in the Fed. So I'd say no direct relation whatsoever, but it has a bigger hand in terms of what the overall market, global market does, and it even impacts even the frontier markets such as Kenya.
Okay, thank you, Churchill. The next question we have is from Nelco. He's continuing the discussion on NBV. So his question here is, any view on the counter? We are close to the support levels. Where do you see the prices going to next? I know we've talked about this a couple of weeks now, and it's usually Wesley who chimes in, but I don't know where Wesley is gone to. So Melody or Churchill?
I'm still here, just that I'm having some issues with the internet connection, so my video is off. But the key driver, to answer this question, the key driver to the price surge has been news. First, news on business restructure, then news on acquisitions that revamps the counters portfolio to some conglomerate-like diversification. So, and since there are no more news, there is nothing juicing up the price action. That said, unless there will be some news in the near term of approvals from NSE and CMA, the price is likely to keep on declining. And I should also mention that we expect the financial towards the end of the month that will give some more color on the standing of the company and the direction we expect and can also project in both the near term and the long term. So that's my brief view.
Thanks, Wesley. Sorry, it was not a case of out of sight, out of mind. So if I get this right, the speculation was based on news, and since news has run out right now, the price is dropping. But with the results coming out next week, we'll see what direction the counter will head.
Well
Okay.
put.
I've been listening. The next question is from George Macquarie. He says that we have one maturity in September for FXD 316.5. That is 23 billion. So a couple of coupon payments, 12 different papers, grossing around 36 billion. Might this too have an impact on the upcoming auction, perhaps making CBK go easy on the competitive bids cast? So several bond coupon payments due, as well as a maturity of a paper. Churchill?
Thanks, George, for those set of questions. For that question, primarily it's addressing the maturity needs. We have there's a maturity that is coming due 2 weeks in 20th. Is it 20th of around 20th of September? And then there's in the course of the September month, we have coupon payments, the interest payments. Look at it this way. One, looking at the value date of the infrastructure bond, I think it's a week before the maturity of this particular paper. It's not coinciding. Had it been coinciding, I had assumed that a portion of the bonds, the proceeds from that infrastructure bond will go to retire that maturing bond. But since it's not, it's coming, the proceeds will come a week earlier. That is, it means that perhaps the maturity of that paper that is due 20th of September will not be retired from the IFB proceeds. The other issue is quite critical. Let me just share my screen briefly to expound on this point. Okay, can't share my screen for some reason. Yeah, I can share, but the thing I want to share is, yeah, this one exactly. Yeah, I hope you can see my screen. But basically, we are looking at this particular, this is the state, this is the budget summary, top where it's been written A, total revenue, and then the expenditure net lending. So interest payment is like top of the recurrent expenditure. We have interest payments where domestic interest and foreign interest come in. So 560 billion interest payment in the current financial year. Sorry, it's 422 billion domestic interest in the current financial year. 38 billion is for foreign payment. But this tells us this issue around consolidated fund services, which is a fast charge. By fast charge, it means that you see this ordinary revenue that is up there, that's coming to 1.775 billion, 1.77 trillion in terms of ordinary revenue. So the fast charge of that is now things to do with things that are in the consolidated fund services. That's where the interest payment falls due. So these coupon payments are coming to 36 billion shillings will primarily be sorted by the revenue, ordinary revenue, be it our taxes, be it our non-tax that is collected. That is where the first charge comes from. So it's not from the bond proceeds whatsoever. So that's why people just try to compare what's the interest payments, be it local, foreign, vis-a-vis the ordinary revenue that is collected. And that's a metric of even our debt sustainability. So in my view, I think primarily the IFB, the timing perhaps is to address the liquidity that we've been seeing is quite heavy. So just as a way of mopping up the excess liquidity, that's where the IFB is. Its appeal is it's attractive to both institutional investors, retail investors, and also foreign investors. And as a subsequence of the latter, foreign interest coming in, we're likely to see even Kenya shilling more or less appreciating in the short term, at least during this period of the sale. And if I take you back to April, when we saw shilling rallying from 108 levels, that is at the start of April, all the way to 106.8 to mid-April, that was because of the infrastructure bond that was right there. So I think that is in my view, that's the rationale around IFB at this point in time, the third in the year, at least to try to address the excess liquidity and mop it up. And as a subsequence or secondary effect of that is at least to have rates shilling more or less contained. That's just my take on that.
All right, thanks for that comprehensive answer. The next question is from Ian. Maybe given the time, we could soldier through the questions because we have 9 open ones. Ian is asking if there's any hope for trans-century counter. Melody, you look prepared.
I wanted to ask Wesley if he could assist, but we know that they have that there are some issues with the how do I put it? Maybe Wesley can assist.
We'll allow it. Wesley, where are you?
Actually, on trans-century, maybe in the near term, we can wait to see, let's say, the next results, which will paint some color on what projection we can make from this point going forth. But for now, as we stand, I think we should wait for the next results to see in this period what changes have happened so far and what we can project and expect from that.
Yeah, we have to see the latest results from trans-century and also the rights issue. I remember that they had given a window for a rights issue, and even one of their shareholders, Kuramo Capital, signed off to that. So it hasn't been fully executed. It's deep in the red in terms of equity, negative equity. So, and it's a way of addressing its capital needs. So it's still a wait and see to see the next phase of implementing of that particular restructuring, corporate restructuring with the company.
All right, thanks guys. Titus's question is interesting because it touches on climate change. He asks, or rather he notes that climate change is posing a threat to agri-based businesses, and there is a possibility of decline in farm output. What is your take on the agriculture sector as a long-term investment? I like this question because it's something you guys don't cover at the moment, but something we once toyed about, having commentary on non-listed sectors in the country. So any off-the-cuff ideas?
Okay, I can give some off-the-cuff ideas, then Sir Churchill and Medley might chime in on some other high-level thinking. But climatologically speaking, future projection for from climate models by the RMITS, that's the Royal Metropolitan Society, indicate an increased rainfall anomaly in East Africa during the short rains caused by the warming of the Western Indian Ocean surface temperature. That said, looking at the effects this has had on the counters in the agricultural sector, most counters have labeled it as favorable weather conditions. So for these counters, maybe it's a plus. I think the main key drivers right now for these counters are the supply and demand dynamics and the exchange rates to the dollar more than the climate change, because for the East African region, it's more of an increased rain in the short, increased rains during the short rains. And for the sector itself, I think it's quite locked. It's highly liquid, and the shares there, they trade quite thinly. Melody, might you have something to add on that?
I think you've covered everything. Maybe just the aspect of now people would have to insure their agricultural businesses because of the uncertainties. Yeah, just ensuring their products, because now because of climate change, you can't really know how the volumes of produce.
All right, thanks guys. I'm impressed by your off-the-cuff responses. Our next question is from Titus. His is about Coop Bank. It's a stock that has for the longest time been below 20 bob. Is the market undervaluing Coop Bank stock? Yet it's a blue chip stock. Its price is below companies such as Santam and NCBA, which do not fall in the NSE 20 category. Is this the correct price, or the market will eventually price it well? So Titus is asking if Coop Bank counter is being undervalued.
I think I can take this one. For me, I believe that the Coop Bank stock is being undervalued, maybe just because of the conservative approach that the bank has. You've seen even they've increased their loan loss provisions, and they haven't diversified regionally as much as you would compare with KCB and Equity. However, they have their own strengths. We've seen that they had the Project Kilele, and where the McKinsey came in and tried to turn around the bank. We've also seen now the acquisition Jamii Bora Bank has now moved into positive territory, which I believe is a good thing. They're also quite focused on their digitization, and they're working on upgrading to a core. They're upgrading their banking platform rather to optimize their costs. So another thing about Coop Bank is their Coop Cash, where they give loans based on salary checkoff. So the amount of risk there is viewed to be quite low. So I think maybe investors just viewing that Cooperative Bank might be considered to be more conservative than its peers. But in the long run, I think that the price will adjust upwards. It still has some value.
I like that. So Titus, there's a tip for you. Daniel has a question for Churchill. He says, Churchill, could you clarify your preference for IFB, the Infrastructure Bond 1, 2021-18, as opposed to the 21-year one? Would I be correct to assume that you expect a coupon rate lower than 12.1% for the 21-year one in the primary auction?
Okay, for clarification purposes, this is now our trade for the week, and this is at the secondary market. Right now, the 21-year infrastructure bond is still in its period of sale up until when the auction results will come out. The value date, I think it will be on the 13th of September. So it will start secondary market trading from 14th of September. So hence, we still haven't even given our indicative bid levels where the 21-year IFB will be. So what we're looking at, or what drove our thoughts for this particular recommendation, is the fact that because there's an IFB at the primary, interest will be at this particular 21-year paper. And what usually happens, what you see in the trend, is that the outstanding IFBs, they could be like some repricing lower. By repricing lower is the yields will go up. There's usually that inverse relationship between yields and the bond prices. So as at the end of last week, this 18-year infrastructure bond, it had an average yield of 12%. But you expect, because there's another 21-year infrastructure bond, that particular 18-year the yield will go up slightly. And that is where the attractive entry levels for people who might want to who may, if not for this infrastructure bond, they'll be looking at getting into the 18-year infrastructure bond at a yield of 12%, which is higher, which makes the bond price higher as compared to if the yield is at say 12.1% or 12.15%, which the price is lower, the inverse relationship. So basically that informed our trade for the week for Daniel. I hope it has clarified. Yeah.
We have we have a question from Kamau. He's concerned about elections being around the corner next year. Are stocks considered election proof? And he also notes that we have specific focus on certain counters as research. What informs this choice of counters? A quick response.
Kamau, that's an interesting set of questions. In terms of election-proof stocks, we don't have usually that gyrations around the political noise. So we don't say that there's one stock that is immune to any particular election. There are so many moving parts that happen with any given election. So even the upcoming one is not an exception. So we don't have one. In terms of our coverage, we are 3 analysts and we have how many sectors? Like 11 different sectors in the bourse. So obviously, there are those counters that we cover actively, be it the telco, banks, insurance company, EBL, a bit of utility companies, because of their market capitalization as we drill down deeper into other stocks. But having said that, our weekly bulletin, the last page of that gives a snippet of all the sectors, be it even agriculture, be it even other sectors that we don't even give like a trade of the week in any given weekly webinar. We have our fundamental analysis around those other stocks over and above the coverage that NSE gives us. So that being the case, unless an investor or anyone wants some coverage in a particular counter that we don't talk about day in, day out, we can now be able to have like a bespoke research or to that particular request. Yeah.
All right, thank you. All right, thank you, Kamal. Hopefully that answers your question. Next we go to James. He's like, what is the market share of KCB? What is the market share of the bank KCB is acquiring in Rwanda? And what is the expected market share that KCB in Rwanda is projected to have in the next 2 years? That is 2021, 2022. Do you have this data?
From there's the circular to their shareholders, they say that the actual market share for Rwanda, KCB Rwanda, in good faith is about 11.1%, and with the combination, it's supposed to come to 17.5%. So that means that they are acquiring about 6.6% of the market share.
All right, 6.6%. Thanks, Melody. Now, I'm not sure what these acronyms mean, but James says, do you have a similar analysis on the DSC and the USC? I'm assuming this is like equivalents of NSC elsewhere in the world, but I'm not sure. Who does? And you're all smiling like it's a secret.
The DSC is Dar es Salaam Stock Exchange. Uganda, USC, Uganda Stock Exchange. Well, so in terms of the market indices, I think what Wesley covers, this one slide in our presentation, the African markets. I think there's one for Dar es Salaam and also Uganda in terms of the high level analysis with the price to.
Did you guys lose Churchill like I did? I was zooming in on that slide he was referring to.
Yes.
Okay, since he mentioned Wesley as the one who creates this slide, maybe Wesley, you can say something.
In terms of
Wesley, the floor is yours.
Yeah. So basically, there's always a snippet on how these markets are performing on a holistic point of view, looking at their counters, looking at their price to earnings ratio, the dividend yields, just giving a holistic picture of how those markets are performing in terms of the earnings investors are expected to get in terms of the day-to-day performance to this point in time of, let's say, from Friday's close, comparing all these sub-Saharan market indexes and looking at their at a snippet of the performance. So we always give a holistic view of the performance, but we don't cover them actively like, hey, DSC, this and this, USC in details. Sir Churchill, I see your back. Maybe you might have one or two.
Actually, your sentiments are similar to my initial sentiments before I got cut off by internet connectivity. So that's it.
All right, thank you guys. I think what we're getting from the last couple of questions is that there's only so much of the market that we can cover at any specific time. But if you receive, okay, now is my camera. Yay! Honestly, how do bloggers do this? The way they show their products and you can see them. But if you receive this particular publication and you're a Genghis client, it has all these things they're talking about. Whether it's a snippet of the different market performances, or if it's just a coverage of all the industries, honestly, this is hard work, of all the counters covered on the NSE. So become a Genghis client, get access to the cross-asset strategy, and you'll have access to all this kind of data. All right, guys, we're tackling the last couple of questions. Willie, I think we had updated this in the last couple of webinars about redeeming Bonga points for trading on the NSE. This is still work in progress. As promised, as soon as this is finalized, we will send out, and I'm in the department that would send out this communication. We will send out this communication saying that now you can go ahead and purchase. So apologies for the inconvenience that it's taken a while, but just hang in there, it'll be resolved soon. Churchill, Nalco wants to know the source of your information. So specific sites that he can look at other than the CBK website and the KNBS website. Are there other websites that you could recommend to Nalco?
If you're looking at the macroeconomic environment, obviously Treasury is a source of information, be it the budget data, be it whatever. Treasury is one useful site that I can think of. Of course, different other websites, be it Moody's, be it Bloomberg. I'm sure that I think Bloomberg is within the market professionals who have access to that, but there are different sites that you can be able to get the first-hand information from, but KNBS, CBK, Treasury stand out for me in terms of the macro coverage.
All right, thanks, Churchill. Nalco had mentioned that he was going to look for you guys, so maybe that can be one of the points of discussions that you guys have. Second last question is, with COVID in the picture and elections coming up, what is your take on the indices in the medium term? I feel like you touched on this when you talked about there not being any election-proof counters, but maybe you could just sum this up. Maybe in the same breath, you could deal with Ian's question, because I think Ian's question is talking about derivatives. When I think he sent this immediately after Wesley's commentary on climate change and agriculture. So he said with agricultural talk, is introduction of future contracts in the agricultural market something to consider? So I think this is talking in terms of derivatives trading. So I know there are two weird ones, but maybe someone could tackle both. Then we could call our session the wrap.
Yeah, so let me just try and give some of my insights on that. In terms of look on the medium term, but now let's narrow two main indices. That's the NASI and the NSE 20 index. So NASI, Nairobi All Share Index, is basically a market-weighted capitalization index, where the biggest counters in terms of market capitalization have a bigger say in that particular index. We're talking about Safaricom and some of the banks, and that's why we've seen even the moves that were there last week had an equal commensurable increase in the NASI index. And then you have the NSE 20 share index. Basically, this is a price weighted index counters that have the largest price in terms of the pricing. Look at BAT, 450 shillings. Look at EABL, close to 200 shillings. They have a bigger weighting than, say, Safaricom, which is at 45, 44 shillings. So those are some of the nuances that we are seeing in the indices. But that said, there's a pickup, at least in some optimism, as COVID-19 risk fades off. So that drives some bullishness into the counters and ultimately to the indices. In terms of the agricultural futures, the contracts, we've seen there's been some pushback between it was CMA and the Ministry of Agriculture in terms of even this commodities index exchange. So there's been some push and back how to actually bring it on board. But from CMA's perspective, they really wanted to bring these commodities, agricultural commodities, to be tracked in the bit through futures. But right now, it's anyone's guess how it will be implemented. So that's just our quick view around that. But that said, futures still on the big names: Safaricom, Equity, KCB, EABL. Those are the 6 single names futures that is offered in the NSE, in addition to with the main index, which is also has a futures index.
All right, Churchill, thank you for that comprehensive answer. I saw Joseph's hand was raised in the attendees list. So Joseph, I've given you the right to speak. Okay, that sounds ominous. I have unmuted you. So if there's something you would like to verbally ask, you can go ahead. I'll give it a couple of seconds. But I think that brings us to the end of our presentation. Joseph, I see you're unmuted. Please go ahead. Hey, Joseph.
Hi.
Or was it by mistake? And here I am being ambitious.
It was by mistake. I'm sorry. It was by mistake.
It's okay. It's good to hear a different voice. Have a good day.
Thank you. Thank you.
Okay. So guys, I think that brings us to the end of a very lengthy discussion, but I think it's been profitable. And I think all the attendees who are part of this engagement got their questions asked. We got to hear Joseph, which is a nice mix. And I just want to wish everyone a really awesome week. Remember, we are on all our social media platforms if you want to continue the conversation. If you have an issue that you need assistance with, please feel free to reach out to us. We're always very engaging. And if you want to start trading with Genghis Capital and get your hands on that really awesome PDF that I will practice showing people, be sure to sign up for an account using the Jacuzzi app. So thank you, Melody. Thank you, Wesley. And thank you, Churchill. And thank you to all the attendees for speaking out with us. Let's meet next week, Monday. Have an awesome week. Bye.